Hi everyone, I wanted to make a quick video on the basics of SPACs and give you a comprehensive list of all the SPACs that are out there. If you're new to the channel, welcome to Buzz Crimson. My name is Shakib. I talk about personal finance and investing. If that's something you're interested in, please subscribe and stay tuned. All right, let's start the video. Okay, so what's a SPAC? If you're new to it, obviously you want to know what that stands for. SPAC stands for Special Purpose Acquisition Company. Other ways people refer to them as blank check company. They are shell companies. Sometimes they're also referred to as reverse merger company. So feel free to go to this example to figure out how a SPAC deal works. I'm just going to give you another example in this video. So let's say Bill Ackman, famous investor, everybody knows him in the finance community, right? He's very passionate about clean energy, and he believes there are a lot of young companies that are, that are up and coming and trying to change the whole outlook of the clean energy sector, right? And he wants to find the best one in this field and give them a lot of cash, essentially buy the company and make it grow faster than it's going to grow on its own. So he launches a blank company, essentially a company that has no business. That's why they call it a shell company, right? It has nothing. So why is it called a blank check company? This is what I understand is, so he establishes a company that has no business, and then he does IPO. So when you do IPO, you're raising money, a lot of money. All these money is going to come into this company that has no business. So just visualize there's a checking account where all this IPO money is coming in, and you just have it on a check. You have, let's say you raised $1 billion. There's this check that has $1 billion. Where is it going to? We don't know yet, right? But eventually it's going to go to a company that is really good in clean energy technology. So who is it going to? It's blank. So blank check company, right? So Bill has maybe 2 years to find this company, make a deal. If he can't, he needs to liquidate the company and return all this money to everyone who purchased shares. So that's pretty much it. So when he finds the really good company, he gives them the money, and then they merge, and then that's it. SPAC deal took place. Bill's done. Bill was probably going to be on the board of that company that they acquired, but yeah, that company goes on. They have a lot of money, and they are gonna grow very fast. That's essentially what a SPAC deal looked like. Okay, let's go over the components of SPAC. Sponsors. So from our example, Bill Ackman or Will Ackman, whatever you want to call him, he is a sponsor or the management team. So reputation is very important in SPAC. If you're a nobody, no one knows who you are, chances are no one is going to buy your shares when you do IPO. So that's not going to work. Consummating period, you generally have a certain amount of time to find a company and make a deal. If you can't, you have to return the money. IPO, everyone knows what that is. Common shares and warrants. So for SPACs, you do have another component. When you are issuing shares, you can also sell warrants. Warrants are like options, but they're a little bit more manual in terms of exercising. And if the SPAC falls through, your warrants become useless. They're worthless. And then the trust, all the money that is raised from IPO, they're put in a trust. Generally they're placed in a safe interest-bearing account, so they are generating some sort of money, and that money is often used for operations and whatnot. Merger and de-SPAC, that's essentially when the deal happens. you merge, and the SPAC is de-SPACed or whatever you want to call it. And then liquidation. If you can't make a deal, you got to liquidate. Okay, so I have 2 slides on pros and cons. Let's just go over them very quickly. SPACs are very lean and cash strapped, right? They have a goal and they have the money to achieve that goal. So this is good. It's like a private equity company, but just on steroids. Defined time period. They also have a defined time, and within this time period, they want to make that deal happen. So that's a good thing if you're investing into SPACs. And it's relatively safe. In fact, even if the SPAC doesn't make a deal, you might get some returns, because once they do IPO, people invest, and based on the trading, the stock might just go up, even though there's nothing. There's no business. It's a blank check company. And in worst case, they're liquidating. You're going to get your money back. There aren't a lot of downsides in terms of when you just think about the stock price and your capital. Cons, there are a lot of SPACs popping out. I think last year they raised like $40 billion. That's pretty significant when you consider there are SPACs raising like 100 million, maybe 300 million. So there are a lot of SPACs. So if there are a lot of them, then there will be less stellar deals to find. Everything will be bought. If there are more SPACs, they're going to bid and they're going to start overpaying for private companies. And then that's bad for the investors who invested in SPAC. And then sometimes sponsors might have an incentive to just make the deal happen, even if it's not a good deal, because they do have a lot of financial incentive. And then, a lot of SPACs are investing in companies that are very high tech or really high up there in terms of concept and business model, which might not be proven or might look really good for the time being. Later, it might come out as lackluster. So you never know. So if you're trying to stick with the outcome of the SPAC deal long term, it might go south. So think about these, keep them in the back of your mind. But let's go to the list. So this is a really long list of all the SPACs that are out there, but you have a lot of good information here. I think status, progress, and focus is probably the most important columns. And I think so this one is probably the best way to look through first. I think you should be able to sort through this column very easily and see. So percent progress means how far. So when you do IPO, the clock starts ticking, and then you have the deadline. So how far is the SPAC in terms of from IPO to deadline? So this bar, spark line, is going to show you. So let's talk about one example. Let's say Fuse, which is a pretty cool one. I do have position in this one. So as you can see, it's got probably like 30% done in terms of the time it's got. So look at that. And then you can also see that its focus is fintech. If you're not into fintech, or you think that fintech is just not going to pop off as much as maybe biotech, don't invest in that, right? And sometimes once you find out the progress, if it's still looking or not, what the focus is, always try to see the sponsors, because if the sponsors are shady, don't invest in that SPAC. And as you can see, there's a trust size and then there's a market cap, because they raise a certain amount of money through the IPO, but then if the stock price goes up, then their market cap can be different from the trust size. But yeah, that's pretty much it for this list. I'm going to make a follow-up video later where I talk about the SPACs that I'm following, like Fuse. I do follow a lot of more SPACs that are in this list, so I'll make a video on that. If you're interested into knowing about the SPACs that I follow, stay tuned. The link for this spreadsheet will be in the video description, so look out for that. That is it. Thank you for watching.